Tariff stalemate. Trump's $350 billion upfront demand risk. Financial turmoil. Soul seeks swap to survive. Trade dispute rarely spiral into full-blown economic crisis. Yet the latest standoff between South Korea and the United States over tariffs and $350 billion investment package is doing precisely that, unsettling markets, testing diplomatic trust, and forcing both governments into an awkward contest of brinkmanship. At issue is U.S. President Donald Trump's demand that soldier pledges be delivered not as loans or guarantees but as upfront cash or equity. President Lee had warned that such condition would drain reserves and risk a replay of 1997, when South Korea was forced into a humiliating rescue by the International Monetary Fund. The concern is not exaggerated, with foreign reserves of around $410 billion, barely a third of Japan's. An immediate cash transfer of this scale would consume most of Seoul's financial defenses and severely limit its ability to stabilize the market. The situation is aggravated by Washington's shifting demand. An agreement in July tied investment to tariff relief, but U.S. officials now insist not only on cash but on a larger sum, citing Japan's $550 billion pledge as precedent. The comparison is deeply flawed. Japan enjoys a reserve currency, a far larger fiscal buffer, and a standing swap line, privileges South Korea does not share. Treating the two as equivalent is less an analytical error than a negotiating tactic designed to raise the stakes. Markets have noticed the won had slid past the symbolic 1400 mark against the dollar, while equities have retreated as foreign investors have pulled back capital. A collapse in talks could bring back tariffs of 25% or higher, hitting an export-driven economy where external demand remains the main growth engine.